Bank of Canada cuts interest rates for the third time. What does it mean for you? Big news from the Bank of Canada today. For the third consecutive time, the Bank of Canada has cut its key interest rates, lowering it to 4.25% from 4.5. This makes a significant continuation of the easing cycle that began June 2024. In total, the policy rate has dropped by 75 basis points over the past few months. This is a major development for borrowers, homeowners, and economy as a whole. The wide-reaching implications for variable rate mortgages, personal loans, and line of credit. But why is the Bank of Canada cutting rates? And what does it mean for the future? Let's break it down. Why are interest rates being cut? The Bank of Canada has been gradually lowering rates in response to the signs of the economic slowdown and easing inflationary pressures. In the previous years, the bank raised rates aggressively to curb inflation. But now that the situation has changed, the inflation's trending lower, currently at 2.5%, and the overall economy showing signs of cooling, the central bank is aiming to stimulate growth by making borrowing more affordable. When interest rates drop, it's cheaper to borrow money, which can boost spending and investments in the economy. However, it's a delicate balance. Cutting rates too aggressively could risk the overheating the housing market or causing unintended inflation spikes. For now, the Bank of Canada appears committed to gradually easing monetary policy in an effort to keep the economy stable without triggering excessive inflation. What's next? Future rate cut expectations. While the Bank of Canada has shown a willingness to continue cutting rates, the pace and the size of the future reductions are uncertain. This uncertainty is due to the dynamic nature of economy, which can shift based on global trends, domestic market conditions, and unforeseen events. Here's what we have so far. Schedule announcement. The Bank of Canada has two more scheduled rate announcements for the remainder of 2024. These dates are critical for anyone with a mortgage loan or investment tied to interest rates. October 23rd, 24, December 11, 2024. During these meetings, the central bank will assess economic data and make a decision whether to cut rates further, hold them steady, or, although unlikely, raise them if conditions changed. What are economists saying? There's a range of opinions from leading economists who where interest rates are headed. Let's take a look at some of the key predictions. TD Economic forecasts that the Bank of Canada will continue cutting rates throughout 2025. By the end of 2025, they predict the overnight lending rate could drop as low as 2.5%. This would represent a significant shift from the higher rates seen in 2023 and early 2024, offering much needed relief for the borrowers. Goldman Sachs is even more aggressive in its prediction. They expect the Bank of Canada to cut rates every meeting between now and the mid 2025, with the policy rate potentially reaching 2.75 by June 2025. This outlook suggests a steady, predictable path for rate cuts, with borrowers benefiting from lower costs for the foreseeable future. A slight majority of economists are forecasting that the Bank of Canada will cut rates more cautiously. These analysts expect the policy rate to reach 4% by the 2024, implying one of the two more 25 basis cuts before the year is out. This scenario reflects a more cautious approach as the bank monitors economy conditions. Factors influences rate decisions. The Bank of Canada has emphasized that its future decision will be data dependent, meaning they will be guided by real time economic data, market conditions. Here are some of the key factors that will influence rate decisions going forward. Inflation trends. Inflation is a top concern for the Bank of Canada. With inflation currently sitting at 2.5%, the bank is on track to meet its long term goal of 2%. However, any signs of inflation rising again could slow or even halt the rate cutting cycle. Economic data beyond inflation, the Bank of Canada considers a range of economic indicators. These include the job market data, GDP growth, and consumer spending. The business investment, a slowdown is any of these areas, could prompt further rate cuts, while stronger than expected data might cause the bank to pause. Market expectations. Financial markets often play a key role in shaping monetary policy decisions. If markets expect further rate cuts, the Bank of Canada may be more inclined to deliver. Conversely, if markets stabilize and borrowing costs decrease on their own, the bank could hold off for further cuts. Global economic conditions. The Canadian economy does not exist in isolation. International trends, especially from the major economies like the United States and China, can influence the Bank of Canada's decision. In particular, the reaction of the US Federal Reserve, which also manages interest rates, could have a significant impact on Canada's monetary policy. potential cer- scenar- the potential scenario the potential scenario of future cut rates, the path ahead of interest rates the path ahead of interest rates remains uncertain, but there are a few potential scenarios for the Bank of Canada might proceed. Gradual reduction. The most likely scenario, according to many economists, is that the Bank of Canada will continue to increment 25 basis points cuts at each meeting. This would allow the banks to slowly ease monetary policy while keeping inflation in check. Another possibility is the Bank of Canada could pause its rates cutting cycles for one or two meetings to assess the economic conditions. If inflation remains under control, the economy continues to slow, the bank could then resume its cuts later in 2025. In more unpredictable scenarios, the bank might adjust the pace and the size of its cuts based on incoming data. For example, if the economy worsens unexpectedly, the bank could opt for a larger 50 basis point cut. On the other hand, if the economic conditions improve, it might slow down the pace of reductions to stop altogether. What does that mean? What does this mean for you? If you're a homeowner, if you're a homeowner or a borrower, these cut rates can have a direct impact on your finances. Here's how it would affect you. Variable rate mortgages. Borrowers with variable rate mortgages are among the biggest beneficiaries of this cut rate. As rates go down, so do monthly payments, freeing up more cash for other expenses or savings. Adjustable rate mortgages. For those adjustable rate mortgages where the payment fluctuates with the prime rate, expect to see lower payments in the coming months. These cuts should provide some relief you been grappling with higher costs over the past year. Fixed rate mortgages, unfortunately, if you're locked into a fixed rate mortgage, these cuts won't affect your payments until your term ends. However, when it's time to renew, you may be able to resecure your lower rate, which could reduce your future payments. Personal loans and lines of credit. Many personal loans and lines of credit are tied to the prime rate. So, as the bank lowers their rate in response to the Bank of Canada's decision, your interest costs will be likely go down. This could mean more affordable payments and less interest over time. Looking ahead to the future rate cuts, the Bank of Canada has made it clear that it will continue to evaluate incoming data before making future decisions. Governor Tiff Macklem is emphasizing one at a time approach, which means while further rate cuts are possible, their timing and size will depend on how the economy performs over the next few months. As the central banks gear up for its next rate announcement on October 23rd, keep an eye keep an eye on the economy. If inflation continues to fall, the economic data weakens, we could see another cut before the year is out. Then on December 11th, the final rate cut of 2024 would set the stage to expect in 2025. If you're wondering how these rate cuts might impact your mortgage or financial strategy, now is the time to act. Reach out to me before and let's explore how you can take advantage of these changes to improve your financial situation. Whether you're considering refinancing, adjusting your loan, or just want to know what your options are, I'm here to help.